Hi, in this video, we'll cover the first few steps of valuing the common stocks. So investors invest in stocks because they expect a return being given from the stocks. Okay, so they will always have an expected return on the stocks, which can be represented as the percentage return on the stock they own. Right? So let's simplify this into a one-time period, which is there's only t equals 0 and t equals 1. So my expected return can be represented as how much am I getting from selling the stock and also receiving the dividend in 1 year's time, divided by the price I have paid for, right? So let's write it in mathematical terms, which will be the expected dividend, let's call it D1, and plus P1, which is the price of the stock in 1 year's time, minus P0, which is something we already know here, divided by P0 here, right? So that's going to be the expected return. So if we break this thing down a little bit, it becomes the expected return of the expected dividend, or D1, in 1 year's time, divided by P0, plus the expected price in 1 year's time, or P1, minus P0 over P0, right? So we could give them names for these two parts. So this part is called the dividend yield, and this part is called the capital gain, right? So it should be very straightforward, as this is basically how much of the return is on the dividend compared to the price that I have paid, and this is how much the price of the stock has gone up or has changed compared to the price that I have invested. Okay, so remember, this is called the dividend yield, and this is called the capital gain. Right. So with this in mind, we can rearrange the equations here. So what if we put P0 on the left hand side, and what is going to be on the left hand side, and what's going to be on the right hand side here? So if we rearrange the stuff, so basically we put the P0 here, and then we have another P0 here, put it to the left hand side, and we divide the 1 plus R here, we can get to the conclusion of P0 is simply the expected dividend at the end of year 1 plus P1, or actually the expected price in 1 year's time, divided by 1 plus the expected return. Okay, so this is pretty straightforward as well. On the numerator, it is the value in 1 year's time, and here this is the appropriate discount rate, which is the expected return, and this is the price right now, which is the present value, which is the price we have paid for the stock. Okay, so remember this. How do we arrive from the expected return to the present value, or the price at t equals 0? And then we can generalize this to any time period. So if I have pt here, then it should be equal to the expected dividend in the next period, which is t plus 1, and the price for the next period, okay, and then divided by 1 plus R here. Okay, so using this, we can expand even further to arrive at the first model of valuing the stock, which we'll discuss in the next video, and I'll see you there.